But aside from China's market giants, where can investors find value in Asia? Fiera Capital's Dominic Bokor-Ingram says Vietnam could be the key for investors looking to unlock returns in emerging Asia. Vietnam continues to be a big focus for us. In our Magna New Frontiers fund, we have more than 15% in the country. The country has continued to reform and those reforms have continued to manifest into economic growth, he says. The economy is consistently growing now at 6% to 7% a year, which puts it among the fastest-growing economies in Asia, according to Citywire. AAA-rated Bokor-Ingram. Pictured below, reforms in Vietnam tend to be enacted quite slowly and even straightforward changes can take time to be realized. But the general direction has definitely been positive, and that's as much from institutional reform as economic reform, he says. In terms of sector bets in Vietnam, Bokor-Ingram was previously invested in the consumer staples sector and, in 2016, held Vietnam-based dairy company Vinamilk among the top 10 positions of the fund. The dairy company did very well and performed very strongly, and we sold out because it became too expensive. The largest holdings we now have in Vietnam are retailers and some of the IPOs that have been happening in the country over the last year. The one issue with Vietnam, and why we think there is less than a 50% chance it will get upgraded to emerging market status in the next year, is the structure of the country's equity bucket. They need to sort out the issues regarding pre-funding and the structure of IPOs, and they need to open the market up to lots more investors. 2017 was a spectacular year for Asian equities. While we think equities could edge higher in 2018, it will be with higher market volatility. The key risk for the Asian market is trade protectionism. China accounts for nearly half of the U.S. trade deficit and is a target for U.S. import tariffs. As the U.S. starts introducing new barriers to trade, how China reacts will be crucial. Hopefully, China's response will be finely balanced to show some pushback, but not so aggressive as to provoke an escalating trade war. At this juncture, investors should stay invested in the Asian market. Many emerging Asian markets are at an earlier stage of the economic cycle than developed markets, which means there is still scope for growth in Asia. This solid economic backdrop should support companies' profitability and would be a bigger factor to drive equity returns in 2018. Bokor-Ingram says there is a lot more interest in the region than there was a year ago and that market volumes have risen substantially. They are slowly changing. They've changed the market structure to the extent that a lot of IPOs are now happening and the market is being used for what it should be used for, which is raising capital to grow. The economy is very positive and there are some very good companies IPOing and raising capital. They just need to make the final changes to the structure to make it easier for investors to actually access the market. Access denied. This difficulty for foreign investors being able to gain access to Vietnam is one reason why GAM's GN Shikartesi has no exposure to the country in the GAM Multi-Stock Asia-focused fund. We are favoring Northern Asian countries, such as China. In Taiwan, we are finding some opportunities, but in Vietnam we don't have any exposure. One reason for this is the country's valuations, and we are seeing very strong earnings revisions in China. Valuations compared to some of the other Asian countries are on the cheaper side, whereas, if we look at the Southeast Asian countries, they tend to trade at higher valuations. Hence why we still find more opportunities in Northern Asia. We remain positive on emerging Asia equities as it is part of our conviction on the global M spectrum. In the past 12 to 18 months, we have invested via a combination of a global emerging market equity approach with a systematic methodology that helps to benefit from a large set of inefficiencies among the different emerging market countries, and a much more concentrated approach via an actively managed in-house certificate dedicated to emerging Asia. Over the coming weeks, we might consider switching part of the diversified exposure and being a bit more selective on the country and sectoral exposure via an actively managed approach. Monitoring risks, U.S. interest rate rises, U.S. dollar appreciation, and being selective is key to continuing to benefit from the strong emerging Asia equity rally. AAA-rated Courtesy, pictured below, says Vietnam is a country with a lot of potential, but the market is still lacking a bit of depth. Also, accessing the Vietnamese market is still not easy. I'm originally from China and I am seeing that Vietnam is going through all of the processes that China has gone through in the last 30 years, with a lot of similar policies. It's also building a manufacturing base starting with an export-driven model and attracting a lot of foreign direct investments. The path is quite clear. It's a country that will have a lot of potential going forward. In general, Courtesy says that Asia is a region that has been ignored by investors, but he says this is set to turn around over the next few years. It's an area that a lot of investors were not widely exposed to, because from 2010 to 2016 there was regional slack in earnings growth. But earnings have started to grow again and we are seeing a continuous revision for Asia, which I think is really a good driver behind Asian equities. We are quite optimistic on the space, poised for growth. This expectation of growth and development across emerging Asia is widely held. Fidelity's Tira Chanpongsang, who manages the Fidelity Fund's Emerging Asia Fund, says emerging Asia markets are able to offer long-term growth prospects driven by low penetration of products and services and strong economic growth potential. The regional stock markets are supported by relatively attractive earnings growth prospects, which are suited for bottom-up stock picking and long-term investment. We like the Schroeder Asian Opportunities Fund. Its performance has been very consistent and in the past 3 years it has outperformed its peers. They have an experienced, local team. In terms of sectors or countries, there are high deviations from the index on a high active share, 67.5%, especially if we don't take into account the top 5 positions, 90.3%. The main underweights are Korea in financials and there is an overweight in Chinese consumer discretionary and IT. Technology stocks have driven the performance of the Asian market, which would explain part of the fund's outperformance. Apart from technology and disruption, the managers are looking for investment themes like the improvement of India after Modi's reforms, world-class exporters and value exposures. They usually include small or mid-cap companies in the portfolio, where they can add value thanks to local knowledge. Chanpongsang, pictured below, said he is focusing on overweights in consumer, financials, healthcare and information technology. Emerging Asia offers durable structural growth prospects, given its favorable demographics, a growing middle class and changing consumption patterns, as well as under-penetrated markets for goods and services. The fast-paced adoption of internet and e-commerce is surpassing the need for physical retailing in large markets and has led to the emergence of new payment gateways and financial mechanisms. At the same time, the underinvestment in infrastructure in these emerging markets is also supportive of durable long-term growth. Domestic growth drivers that are able to generate long-term growth have also piqued the interest of UBS's Manish Modi, pictured below, who manages several funds at the firm, including the UBS Asian Consumption Fund. AAA-rated Modi says Southeast Asia is delivering favorable secular growth drivers at a domestic level. Export-oriented economies such as Thailand and Malaysia have benefited from an export recovery. Although this has yet to spill over significantly to domestic demand, we expect the export momentum and a pickup in commodity prices to gradually boost capex and consumer spending across the region. In addition, upcoming elections in Indonesia, Malaysia and Thailand may spur fiscal support, including attempts to accelerate infrastructure spending. Like Chang Pongsang, Modi is looking towards technology-driven sectors, but he has a keen interest in Korea. There has been some progress on chaebol reform. The Korean National Pension Service announced it would adopt the Stewardship Code, which encourages institutional investors to exercise their voting rights and be more actively involved in the corporate management of companies they invest in 2018. This could translate to better corporate governance among listed corporates. We hope to see the Korean economy maintain its large current account surpluses, which are a testament to the rising technology-driven competitiveness of the Korean economy.